Are you dreaming of financial freedom but unsure if you should be trading stocks or investing for the long term? The difference between these two approaches could mean the difference between growing your wealth steadily or losing your hard-earned money. Most people don't realize that trading and investing are fundamentally different. And for the majority, trading is not just risky, it's often a path to financial setbacks. Today, let's unravel why trading isn't for everyone and why long-term investing is the proven strategy for building sustainable wealth. Stay tuned until the end because I'll also share some critical tips for making the smart financial moves of your life. Welcome back to The Money Philosopher. Today, we're diving into a topic that confuses many beginner and even intermediate market participants: trading versus investing. These two approaches often get lumped together, but in reality, they are completely different strategies that require vastly different mindsets, skill sets, and levels of commitment. If you're someone looking to grow your money, retire comfortably, or build a legacy of wealth, this video will explain why most people are better off investing rather than trading. Whether you're just starting your financial journey or you've been dabbling in the markets for years, this breakdown will help you understand the clear distinctions, the risks involved, and why the slow and steady approach of investing almost always wins the race. Let's get started by understanding the basics of what trading and investing actually are. Section 1. The basics of trading and investing. At first glance, trading and investing might look similar. Both involve buying and selling assets like stocks, ETFs, or cryptocurrencies. But here's where the similarities end. Trading is a fast-paced, short-term strategy. The goal of a trader is to profit from small price fluctuations in the market. Traders often buy and sell assets within minutes, hours, or days, relying on market timing and technical analysis to make their decisions. It's about quick wins, but it's also fraught with high risks. Investing, on the other hand, is a long-term game. Investors purchase assets like stocks, bonds, or ETFs with the intention of holding them for years, sometimes decades. The focus is on steady growth, dividends, and the power of compounding returns. Think of it as planting a tree and letting it grow over time, rather than cutting down trees for firewood every day. 2. The risks of trading. Trading may sound exciting and even glamorous after all. Who wouldn't want to make money quickly? But for the average person, trading is more of a gamble than a reliable strategy. Let's explore the key risks. Emotional decision-making. Trading requires constant attention to market movements, which can lead to emotional decisions. When prices spike, fear of missing out, FOMO, can cause traders to buy impulsively. When prices drop, panic can set in, leading to premature selling. This emotional roller coaster often results in losses, high costs, and fees. Every time you make a trade, you incur transaction costs. Whether it's brokerage fees, taxes, or spreads, these costs add up over time. Even if you're making small gains on each trade, the fees can eat into your profits, leaving you with little to show for your efforts. Time intensive. Trading is not a side hustle, it's a full-time job. Successful traders spend hours analyzing charts, reading news, and staying updated on market trends. For most people, this level of commitment is neither practical nor sustainable. Statistical reality. Studies show that over 90% of retail traders lose money in the long run. The odds are stacked against you, especially if you lack the experience and resources of institutional traders. 3. Why investing is the smarter choice. Now let's talk about why long-term investing is the strategy most people should adopt. Power of compounding. Investing allows your money to grow exponentially over time, thanks to compounding. By reinvesting your returns, you can generate earnings on both your principal and past gains. This snowball effect is the secret behind building wealth, lower stress and effort. Unlike trading, investing doesn't require you to monitor the market daily. Once you've chosen quality assets, you can sit back and let time do the work. It's a passive strategy that frees you from the anxiety of constant price fluctuations. Proven historical returns. The stock market has historically delivered average annual returns of around 7 to 10%. While there are ups and downs along the way, the long-term trend has always been upward. By staying invested, you can ride out market volatility and benefit from overall growth. Diversification reduces risk. Investing allows you to spread your money across different asset classes, industries, and regions. This diversification reduces risk and ensures that no single investment can jeopardize your financial future. 4. Trading versus investing. A psychological perspective. One of the biggest differences between trading and investing is the mindset required. Trading appeals to people seeking instant gratification. The promise of quick profits can be tempting, but it often leads to impulsive decisions and burnout. Investing is about patience and discipline. It's not flashy, but it's reliable. It rewards those who can think long-term and avoid being swayed by short-term noise. 5. Final advice for choosing the right path. If you're still unsure which path to take, consider these questions. Do you have the time, tools, and expertise to trade effectively? Can you handle the emotional highs and lows of rapid market changes? Are you willing to accept the high costs and risks associated with trading? For most people, the answer is no. And that's okay. Investing is a proven path to building wealth over time. If you found this video helpful, make sure to hit the like button and subscribe to The Money Philosopher. Share your thoughts in the comments. Are you a trader or an investor? And what's your experience been like?